perma bear. All right, guys, this is going to be the broken wing butterfly. This is being recorded. One thing I always say at the beginning of these is watch this again relatively soon after. We're going to be sending this out later on today or tomorrow morning, and watch it, you know, within a couple of days so that it really sinks in and some of the nuances don't get lost on you. If you wait a month down the road, it's going to be like learning it all over again. So try and watch it relatively soon after so it sticks with you a little bit better. All right, so let me get a couple of things out of the way real quick. My name's Eric Wilkinson. Some of you guys may recognize me as the Wolfman from CNBC, Fox Business, or the Wall Street Journal. Been trading over 20 years now. It's about 25 years now. I started trading in college with some money I'd earned, switched my major from psychology to finance, and after graduating college with a finance degree, moved up to Chicago, sold all my stocks, and bought a badge. So started trading in the pits shortly thereafter. I actually started out as a runner. Those guys that run around with the paper and hand it into the pit. And then sold my badge and moved in there. And in that time, I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all these products in all market conditions. So I've seen a lot of different crazy things going on. And any opinions, news, research, and analysis or other information contained here or material provided by ProTrader Strategies and associated companies or employees is provided as general commentary. It does not constitute investment advice or solicitation to buy or sell any of these securities, strategies, or whatnot. Basically what it means, the reason why I can't do that is I don't know your personal investment portfolio, what you have in there. I don't know what your risk parameters are, and you know, the powers that be that make the laws and everything else say that I can't do that, which is the right thing, and that I don't always agree with everything that they say, but that is one of the things I do agree with, is I cannot really give you solid investment advice without knowing all your ins and outs of who you are, what your investment prowess is, all of that stuff. Please remember that past performance of any trading system or methodology is not necessarily indicative of future results. All right, guys, you can follow me on Twitter at Wolfman's blog, and you can follow ProTrader Strategies at ProTraderStrat. We're heading into earnings season, and I pump out a lot of my earnings trades on Twitter for you guys and the people that follow my daily market commentaries are subscribers to that because I do the market commentaries in the morning and earnings I do in the afternoon. So I actually talk about what I think I'm going to do with the earnings trade and then put the earnings trade on, throw it out on Twitter so that you guys can get it. I don't do that for all my followers necessarily. I wouldn't do that for them, but I will do it for you guys. So if 5,000 other people have to get it, then so be it. All right. This is going to, like I mentioned, going to be on the broken wing butterfly. This is a really good one. I like this more than the regular butterfly, because with the regular butterfly you kind of nail the number in a sense, but with this one you get a little bit more leeway in one direction, which is to the downside, and that is nice. But you know, anytime you're getting, you know, better probabilities, you got to kind of give a little bit in risk in a sense too. So all right, this is also known as a skip strike butterfly or wounded wing butterfly. I just call it the broken wing butterfly. It's what I grew up knowing it as, and that's kind of how I'll refer to it. And with this, we want to be market neutral. Now, the thing with this one versus the broken wing put butterfly, the broken wing put butterfly, we'd limit our risk to the upside. This is going to eliminate our risk to the downside. So that's, if you know, especially with all-time highs, you know, and people are talking about a bit of a correction, despite the fact that the economic data coming out is pretty good, aside from today's unemployment number, which was basically due to the hurricanes. But you want to be market neutral. But if you have an inkling that this market could go down, then this is the one to put on. So it's market neutral to bearish, if you will, despite the fact that it has calls involved in it. All right, so we have the market assumption, which is going to be neutral. we want high implied volatility percent in this, greater than 50 for any stock, greater than 30 for an ETF or something along those lines. The reason why we want that high implied volatility percent, you guys, is because you end up getting a better credit, because those ones that we're selling at the money are going to be pumped full of premium. So the ones that are closest to at the money will be the juiciest, if you will. All right, so we want high implied volatility, because if you do this with low implied volatility, for one, a lot of times you'll end up setting this up and it'll look like you're going to be paying a debit. Never, ever, ever do the broken wing butterfly if you have to pay a debit. Okay, it does not make sense. The reason why it doesn't make sense is because you're increasing your risk to one side. Why increase your risk to the downside also? So you need to be able to do this for a credit or zero. I don't even like to do it for zero necessarily, but that's my rules on that. If I really like the trade, then I'll do it that way, but I'd like to really get a credit. All right, here's how we set it up. And one thing with this is we're setting it up, we're buying or selling the two at the monies, and then we're buying an in the money one. That's basically the next strike out, you know. And then we're on the upside, we're skipping one strike to buy that out of the money call. And what happens here, in a sense, is we're basically putting a short call spread. We're embedding a short call spread in this side of it, and that selling that short call spread, in a sense, by selling the wing that is just, you know, would have been an equal distance butterfly, a regular butterfly. With this, in a sense, you can kind of think of it as we're selling a call spread to finance this part of the spread. So, you know, you can look at it where you're doing a long call spread and a short call spread. Well, in a sense, there's a synthetic embedded call spread. Now, I don't want to confuse everybody, but some people that are, you know, a little bit more savvy about options, you can think of it that way, where that embedded call spread, where you're selling the just out of the money call and then buying further out of the money call. So it kind of finances it. It's another way to think about it, I guess. All right, what indicators are you using for direction? Robert, I use a lot of different indicators for direction, and you know, there's one thing I always say is, like, you know, it's kind of like after you pump all this information into your head, you kind of get a gut instinct. I look at the candles, I look at the market profile, I look at a lot of different things, and you know, kind of come up with my assumption that way. And I don't have any hard rule on that necessarily, other than I just go with my gut instinct after I'm looking at things for the most part. Trevor's in the house. Yes, Robert, remind me to, I probably will do it, but remind me to rule out for defense on that. I will. Okay. Papers, don't runners get coffee and other traders? Yes, Trevor, that's exactly what they do. I actually have a funny story about that. I had a runner one time where she thought her job was just running to get paper and stuff like that, and I asked her to go get me a pack of gum, gave her $1, and she left with the $1 and never came back. I guess it was a little, she thought it was below her to have to do that. And I was like, well, I don't get to leave for lunch, so I need gum. Anyway, moving on. So traditional butterfly and versus the broken wing butterfly. With the traditional butterfly, you really have to nail that number, right? I mean, if you guys have traded, I know I see a lot of returning guys. I know a lot of you guys have traded. With a butterfly, it is hard to nail that number. Now, I do have rules to increase your probabilities with just a traditional butterfly, which I'm not really going to go over in here. But with a broken wing butterfly, by adding that synthetic embedded short call spread to finance it, it transfers that risk to the upside, but it eliminates our risk to the downside, which is nice. So, but keep in mind, we are going to have a higher profit potential, and one of the reasons being is if it goes down, we still get to keep that credit that we collected. But we do have a higher max loss than a regular butterfly because of that embedded short call spread. All right, and we're protected to the downside. I think I've mentioned a few times. All right, so the keys to success with this, picking that right underlying. I talk about this all the time, you guys. The right underlying is essential to any options trading success, in a sense, because if you're trading stuff like Aon, which everybody's heard of Aon, there's just no option activity in there. And those bid asks get really wide. Even things like Kellogg, which I do trade Kellogg because I like that stock, it does have, it teeters on going outside of my comfort zone for wide bid ask. And those are only like 15 cents wide. So, but that is outside of my range, because anytime something gets busy, if the markets start getting busy, people are going to fly out of Kellogg and go to Apple and do those trades. Kroger is going to get even wider, so it's going to be even more difficult to get in and out of that. So picking the right underlying, this means a stock that's under $100, bid ask should be 10 cents wide. Anything over $100, we just move the decimal 3 ticks to the left, and that's how wide your strikes from bid ask, the width should be. So for instance, a $300 stock, you move that 3 ticks to the left, 30 cents from bid to ask on any of the options that are in the near expiration cycle. So that doesn't necessarily mean weeklies. I mean the full month ones where most people are trading. Okay, and then picking the right strikes with this, making sure with this one that we are collecting a credit and or doing it for no outlay of cash. If you have to do it for a debit, do not do this broken wing butterfly. It's not worth it. You might as well do the regular butterfly. If you're really thinking, I'm market neutral on this, we got high implied volatility, yada, yada, yada. I do the broken wing, it's not giving me a credit. Just do the regular butterfly then. Because then, you're not increasing your risk on one side and still having risk at the downside. That doesn't make sense. You might as well even out your risk. All right, so the duration, picking the right duration. We want this decay for those. We want those at the monies to decay. We want that money right away. So we want to get that credit that increases our potential. So we want to be on that. We want to be like less than 35 days for the right duration. Okay, picking the right environment. We want high implied volatility. That's what I mentioned there. In and around that underlying. We don't want earnings. I don't like to do this around earnings, on earnings, because we want to nail the number. And it's, how often have you ever seen a company come out with their earnings and the market didn't move at all? It's a very rare occasion. So don't do this one necessarily around earnings. Some of the examples we're going to be talking about to get high implied volatility, because next month is stock, lock, and barrel full of earnings. We're going to be using some of those as an example, but please don't use this in and around earnings. It's not very wise. It's good when we have a stock that is feeling high implied volatility, not around their earnings cycle. All right, picking the right exit strategy. We know our exit strategy before entering the trade on every option strategy. You guys know your exit strategy. Write it down. I have a book right here. Actually, I have like more than one book. I have 1, 2, 3, 4. I have 5 spiral notebooks sitting right here at my desk where I write down all of my trades and why I got into them, when I'm going to get out of them, and where I got out of them, and what happened in and around that. Just to so when you go back and look at it again, that you realize what you have done and why you did it, and if it worked or not. All right. The other thing is if you write down your exit strategy, you're more likely to stick to that exit strategy than if you were to just kind of keep it in your head. I've seen it so many times where some people will say they're getting out of a trade and then they're like, well, maybe I'll just wait till tomorrow. Well, you wait till tomorrow, usually that's when it hits the fan, so to speak. So know your exit strategy with this. Basically what we're going to look to do is exit for about 50% of our max profit, and we'll probably leave this on. I usually leave this on because it's defined risk strategy. Somebody was talking about how you defend this and things of that nature. Since I know my risk to the upside if this trades higher, I'm going to usually leave this on. So this is just these are a couple of older examples of the broken wing butterfly versus the traditional butterfly. This is the traditional butterfly. You got risk on both sides. This would be the broken wing butterfly. So this is what we're trying to do, collect this credit. So if the market goes down, we still get to keep that little bit of credit. In this case, it was 16 cents. One thing to keep in mind, this strategy has a tendency to work better with higher priced stocks, basically above 50. The lower priced stocks, it's really hard to get a decent credit out of those, especially when you're going in the money and stuff like that. And when you skip that strike, then you don't really get paid very, that embedded call spread doesn't really pay you enough. So limited risk all the way down to the downside, but you notice we will increase our risk here. It's basically the same stock, but you can see that embedded call spread that lands right here, in a sense, when we're looking at this, the 41, 44.50, we skipped over what is that, the 47 strike, skipped over that 47. So we're basically selling the 47 and buying the 50 calls, selling 47.50 call spread. That's where you're getting paid for this part of it. Okay, I see you guys have a lot of questions coming up, so I'll try and get to those here in a second. Let me just run through these real quick. Like I mentioned, the profit target on this, our exit strategy is 50% of our max profit, and that is, when 50% of this max profit, or if it goes down here and trading down and away. This is one of those few strategies I'll let go into, the last 10 days, if you will, especially if it's way down here. I'm going to probably ride that out to come back up. And even if it's a losing trade, I'm probably just going to ride it out as well. If you have lower risk tolerance on this, you could look at it like, 50% of your max loss or something like that you might get out of if it's going wrong. And one other thing I always say, if you've got a gut instinct that's telling you, what, it's starting to trade up here, just maybe you read an article or something like that, get out of it when your gut's telling you to get out of it. That's the best thing to follow in my eyes. All right, so your max profit is the middle strike. That's the one that we're selling, and minus the lower strike. That's the middle strike minus the lower strike plus the net credit received, okay? That's your max profit. Now, your max loss is on the flip side. Your max loss is that higher strike minus the skip strike minus the credit received, all right? Times 100. I have times 100 because, options are worth 100 of the underlying. Skip strike is the break even plus the net credit. All right, so that skip strike in that case of Best Buy, I think it was the 47 strike plus the net credit. All right, plus the width of the long spread, which is the one that's in the money and the out of the money. I'll go into those in a little more detail. I know those can be a little confusing. We'll do it when we're pulling it up. All right, so just as a recap, this is a play on Vega, and we're going to try and exploit theta on this, which is time decay. We're trying to exploit that time decay that's happening. All right, so let's pull this up. This is usually when I throw it out to you guys to start getting some. I have some that I've already vetted, but to make it more interesting for you guys, throw out some stocks. We'll go through my rules, like the right underlying and things of that nature, and see if it fits for us. And in the meantime, while you guys are throwing those in there, I'll go over some of these questions I saw. Is it possible to trade options without knowing direction? Absolutely, it is possible, Jans, without knowing direction. That's the beauty in options as far as I'm concerned. One of the things to trade around that when you don't have a real market direction is the strangle, as far as I'm concerned. And the beauty in options, especially when you can sell options, which is my favorite thing to do, if you're selling options, you can be directionally wrong and still make money. When you're buying options, you need to be pretty right on, and you need to be right on right away. But with selling options, you can be directionally wrong. It can start going against you, and you can still make money. So who else was? I thought I saw another one. Can you talk about when to buy the in the money and when to buy the at the money calls? If you're talking about a directional assumption, we can do a little bit of that, I think. But usually with this one, it doesn't work out very well because you end up doing it for a debit if you go too far away. I'm not very certain about what happens if the equity goes up suddenly beyond the short body into the 50 call. That's when you're, John, that's when you're going to be at a max loss. So we'll go over that a little bit more here in a second. So when I can pull it up like a real example on the Analyze tab. All right. Merrill wants Costco. All right. So we'll get that in a second here. When you say play on Vega, do you mean you want Vega to increase or decrease? I want Vega to decrease with this one. So we're collecting a credit, and when you collect a credit, you want this to go down. And since we're selling that at the money also, if volatility goes down, those premiums go down rather quickly. So that's what we want to have happen. All right. Also, if you have time, what does the monkey bar do in the volume profile? The monkey bars, basically, there's two things here, right, over here on the side. This basically just tells me where people are putting their money where their mouth is. To me, it gives, I talked about in the beginning about the psychology of the market. To me, this tells me the psychology of the market. You can see, even if something's trending sideways, I think, I can't remember, I just saw one where it's been trading sideways for a long time, but there's no volume, and the blue part is the volume where actual trades are happening. And the time is the little numbers or letters underneath there. Every 30 minutes there's a new letter there. So we use on the floor, sorry, I forgot to turn off my Skype. Let me just try and get this thing shut off. So, when there's a lot of money being traded back and forth, that's where, people are putting their money where their mouth is, in a sense. So those are, to me, going to be magnets, because whenever the market is overextended to one side, people start, getting out of positions, or people start puking out of positions. But once it comes back down to like where this is right here, everybody's happy, in a sense. Nobody's making money, nobody's losing money, so everybody's content. So it has a tendency to come back to those levels. It's just a psychology of trading, in a sense. All right, so I think I went over that enough. All right, so first one was Costco. So we can look at Costco, and they just came out with earnings, but they still do have high implied volatility, so we probably still take advantage of that. It is right there at the high volume node for the time and the amount of transactions that have happened, very close to it anyway. It would limit it if it continues to go down. I mean, they came out with better than expected earnings, so I could easily see it want to kind of migrate to this area. All of those things being said, you beat earnings and you get beat up like that, it could easily continue down, right? So let's look at Costco. And we want to go with a high implied volatility percent. That's this right here. One thing to note, you can see all these not applicable or can't really calculate. You need to know this formula. And basically what this formula is, you have a numerator and a denominator, and the numerator, which is on top, you're taking one sum and dividing it by another sum. The sum in the top that we're looking to find is you take where current implied volatility is, which is 19, let's just call it 20 to make math easy, and subtract that by the low, which is 12. So in the numerator we have 8, and in the denominator we take the high, which is 23, minus the low, which is 12, so 11. So basically you take 8 divided by 11 and you're going to basically come out somewhere around 69 if you do the exact math. But sometimes there's a break in the action here where for some reason, let's just look at Priceline or something like that, where there's a break in it and your platform may not be able to read it, and or your platform may not even have it. So that's what you do. Current implied volatility minus the low implied volatility, and divide that sum by the sum of the high minus the low, and that's where you're going to get implied volatility. And Priceline has high implied volatility, but they probably have earnings coming out too. So, but Costco could be, and one thing to note, $1,900 stock, the bid ask should be about $1.90 wide on these here, on the at the monies. I have it on all. So $1.90. These are a little bit wide right now, but it's on a Friday. So let's look at Costco again. Costco is $1.50. So we would think that we need the bid ask to be somewhere around 15 cents. 15, 16 cents, and as you can see, they're inside of that. That's 10 cents wide, so that meets that rule, right? So with Costco, what we're going to do is trade in 157. It's almost a pick 'em between the 60s and the 55s. I'm probably going to look to go with the 60s because I'm slightly more bullish on this, but we'll look at both of them, see if it works out. And then first thing you do is buy that one that is just in the money, so the 55s to the downside. And then normally what we would be doing, since we did the 60s, a normal butterfly would have the 65s, right? And we'd be paying a debit for that. So now what we're kind of doing here is we're going to sell synthetically this the 65s and buy the 70s. So in a sense, you're selling the 65s to get out and then buying the 70s, which basically does that, right? And I've got to, it's going to give me for a debit. So that, don't ever do that. It's not working out. So the other thing to look at is selling the 55s, buying the 50s, and then you're skipping that strike and buying the 65s. So then we're getting a credit for it. So as long as that stays somewhere around 55, you're good. But to me, that means it's got to go down a little bit further. That's your assumption. You got to think about your assumption there. That was a big move down today too, by the way. I mean, like 6% move or something like that. So that's what you have to weigh. Where do you think it's going to go? My thought process would probably be it would go to the 60s. So that's where I would want to do it. But if that being the case, those 60s didn't work out, so I would probably, in this case, then just do the regular butterfly if that was my assumption, market neutral going to 60, which would be my market assumption, not necessarily yours. But so then in that case, I would probably just do the regular butterfly. But don't do it unless you can get a credit. So now let's look at this as on the Analyze tab real quick, just so you guys can see it, what it looks like. So go to Analyze Trade, hopefully. Bueller. Because my computer's freezing up. Can everybody hear me? Just to make sure my computer's still working. Okay, good enough. was hoping my whole computer didn't freeze up. Just this platform seems to be running super slow right now. So, okay, great. Thank you, guys. Everybody can hear me good. John, I'm going to be doing the put side next week. Right? I don't know why that's Costco, because I had that earnings trade in there. So anyway, the earnings trade that did not work out. So this is what it's going to look like on the Analyze tab. You know, we're increasing our risk to the upside, but we've completely eliminated our risk to the downside if this continues to go down. Right? And obviously, we want it to pin at 155 to get our max profit on there, which is, you know, basically $550, because the width of this call spread is $5, right? $5. That's our max profit plus the credit we received, which was 50 cents. So $5.50 to that upside. So in this case, you know, if we could get out for $2.75, that's probably where I'm getting out at, because that's 50% of my max profit. That would be a home run in my eyes. I'm not going to squeeze it out for any more than that. I might even take, you know, you can even go for a quarter to 50% of your max profit on this strategy, because with the butterfly, I usually take about a quarter of max profit, quarter, 30% max profit. So somewhere in there. And the faster that happens, the more likely I'm going to be taking less. So, you know, if I was in this trade for 5-6 days and I could get a quarter of my max profit, I'm going to pull the ripcord on this trade. Okay? Does that make sense for everybody? Do you ever mess with commodity options or stick with stocks? Charlie, I used to trade a lot of commodity stocks, to be quite honest, but, you know, I don't do it as much anymore. But yeah, you could definitely do this with commodities for sure. I mean, in commodities, when I'm thinking commodities, I guess I think of like the grains for the commodities. Like gold, I still trade gold, silver, stuff like that. But I don't really trade the grains so much. I actually used to go out into cornfields and determine what the bushels per acre for the national average was going to be. That's how much I used to trade commodities, Charlie, if that answers your question. All right, so not being rude, but leaving. Okay, yes. I'll keep following more and learn. Okay, thank you very much, Stefano. He's not here anymore, but thank you for your kind words. What's the expected move for Costco and days to expiration? The expected move for Costco, you can figure that out in the next 45 days, is $8.61. Okay, but keep in mind, that's based on volatility, right? That's based on this volatility. And if volatility continues to go down, that number is going to go down also. So that's another reason we want to do this in high implied volatility environments. For one, it allows us to get further away, make those wings a little bit wider to increase our probability of success. And, you know, volatility has a tendency to revert back to the mean. As you can see, it has a tendency to kind of revert back to this area and stay there for a while. Well, when it gets outside of that area, that's why we play above that line, selling strategies, and below this line, buying strategies, because it's, you know, the probabilities are when it's really low that it's going to go back up. When it's really high, you can see, I mean, I don't even have to do the math for you. You can see that it has a tendency to come back down. And that's what we're seeing here. So, and that's just because their earnings are all done. But we could easily see this come down another, you know, 3-4 points to the downside. And 3 or 4 points is actually a lot, to be quite honest, because this is another thing you could say. 4 points from 20 is 25% in a sense, right? So, I mean, just as off the top of my head. So a decrease of 25% in volatility, what we can do is look at this. What a decrease of 25%. Now this adjust volatility here, and this is a percent of a percent. So, you know, That's what I'm talking about with that. So if it decreased by 25%, so if this number decreases by 25% and goes somewhere close to 15 in a sense, we can see what that's going to do to premiums. And as you can see here, this doesn't seem to be working very well anymore. This used to work really well. The theoretical price is going to zero on that, and that doesn't make sense unless they've adjusted this number and didn't tell me. Let's just see if this, so 4%. Okay, so let's just say it goes down by 4 percentage points. I think they used to have this where it was 1% of a percent. Maybe they've changed that. So maybe this percent goes down by 4% to 16-ish. Then you can see the pricing on these is going to go down. Why is that going up? I don't know. I don't know what's happening with this. There's something wanky with this, and it hasn't been working for the last couple of months for good examples. So 10.6. Let's just reset everything. Let me just see if this, I had that day wrong. So down by 4%. There we go. So if it goes down by 4%, I must have had that date wrong up there and wasn't paying attention. But you can see it goes down by 4%. These, and the days haven't changed. These go down quite dramatically. So that's why we want volatility to come out. Whereas if volatility had gone up, you'll be able to see if it just goes up, what happens. I mean, up almost by $1 there, up by 60 cents there. I mean, so that's why we don't want volatility to go up, because that kind of is what happens to our premiums. Does that make sense for everybody? Isn't one side of the butterfly seen as a credit spread bull call? One side is, David. I'm sorry, John. I keep calling you David. But the one side, there's an embedded short call spread in there. It's a credit spread. So it's when you're selling a call spread, that's actually a bear call spread. Okay. There's an embedded bear call spread in there. Yes, there's actually the in the money one, this one. So I don't know if I'm answering your question right. This one here, this 50-55 is a long call spread. And then you're right, this 55-65 is a bear call spread. Because you're long a 50-55 call spread, you're short a 55-65 call spread. But what I was saying with this, what strikes do I have? 60 I want. What I was saying, this is the regular butterfly here, okay? And you have a long call spread, the 50-55 long call spread, the short, the 55-60 call spread. Those added together create the butterfly. But then what happens is, to create the broken wing butterfly, you embed another short call spread, and that short call spread is going to be the short 60, long 65 calls, which is a short call spread or bear call spread. So we, in a sense, let's pretend I buy those 60 calls back, and then I sell the 65 calls, or I sold the 60 calls and then buy the 65 calls to embed that short call spread. Does that make sense? Okay, good. Since you are in toss, can you demonstrate rolling out the trade? Yes. So, for instance, what we would do is, what we would do there, so it's kind of hard since I don't have on this strategy. I'm going to be putting one of these strategies on Monday, probably be Costco. But basically, all you're going to do is roll that out. We're going to play with this. We're going to need to roll this out when we get the December contracts, which they don't have for this right now. But let's just say we were rolling it out. Basically, we're going to roll it out to the same strikes. So we would be doing the 50, 55, 60 again. And in that, let's just say we were rolling this out today. What we would get would be buying the 50s, selling 2 of the 55s and then buying the 60s. Wait, is that the same strikes I had for the other one? 50, it was a 65. Wait, sorry, I forget which one I had on for the other one. Oh, it was 65, right? Would have been the 65. The other thing to look is right here. When you do set this up, you can see how much of a credit you have in order to buy the next call. So sometimes, like if you remember on that Best Buy strategy, you know, that one was a little bit odd because it was a little off on it, I think. But basically, look at this and see, okay, well, you know, I can pay somewhere around $4.50 for the next strike, and you can look at it that way as well, and that's where you go to buy it and still get a credit. So 60-cent credit. So if we were rolling this strategy out again, we would be able to collect another 60 cents for that. So that would increase our max profit potential in a sense, and our break even by another 60 cents. It should be the 65, not the 63s, right? Should be the 65s. It could, yeah. But the other thing I was saying is with this one, remember, so if we were setting this one up around this strategy here, for one, I'd probably pick the 58, but let's just try and keep this as simple as possible. So the 55s on this one, we sold we're selling 2 of those, right? And then we're buying the 50s, which is this here. And then I've got a $4.50 credit. So when you're setting this up, I got a $4.50 credit that I can spend. So how can I best spend it? Well, that is why I picked this strike. It's $4. So I can do this one and lower my risk to the upside, right? Oops, I meant to buy that. See what I'm saying there? So I had that much money and I still got a credit. Now I've limited my risk a little bit more to the upside. So now it's not completely equal distance, and it doesn't have to be. Just remember, all we're doing is selling the 6. Now we're just selling the 60 and buying the 63s. That embedded call spread. So you can play around with these wings. It doesn't always have to be perfectly equal distance. It's up to you. You know, as long as you can get a credit. And with this, I was able to limit my risk to the upside by $2, and you know, by not getting, you know, if I would have done the 65s, I limited my risk by $2 to save myself 70 cents, right? So to me, that risk reward would be better. You know, I didn't get to get that extra dollar, but I've also, or that extra 80 cents, but I've limited my risk to the upside by $2. That makes sense, everybody? So when you're setting these up, it's not always having to be equal distance. Just the best way to do it is to go in there, you sell this here, then you look where you're buying it, you know, $5 wide on something that's over $100 is probably where I would go almost every time. And then you say, okay, well, I've got a credit of $4.50. So how can I best spend that money? Well, right there, to me, would be the best risk reward for that, rather than going to 65s. Okay. So I keep doing that. I'm sorry. So TJ, you're asking, can I set this broken wing butterfly up for a downside move? Does that mean go deeper in the money in a sense? We could do that. But this is set up for more of a downside move. The call broken wing butterfly is set up for a downside move to limit that risk. Because if you remember, when we set it up with the if you remember when we set it up with the Analyze tab, it shows you're limiting your risk. So we can check this out though. Let's try and sell these two, buy the 45s, and then if you thought it was going to go down. So 55, so 60 is where we're probably going to be buying it. I got $7 to spend, so it's the 50, maybe even the 58s I would do. Still collect a credit. So you can do that too. It's a little bit easier to go in the money further than out of the money. It doesn't work out as well. You usually end up doing it for debit if you're going out of the money. So let's just look at this on the Analyze tab. Get rid of, so the 55, 65. Let's get rid of that one. And you can see your break evens. And that's a pretty good one. We're pretty far out in time because I'm out in the January, but you know, if you could do something like that all the time, that would be great. So let's just see. Let's look at this one as an out of the money one, just for sake of argument. So if I'm going out of the money on this one and buying that one, so 55, 60, I got a 10-cent credit. You know, so if I even just skip the 65s and went to the 70s, I'm going to be doing that. I keep buying it, darn it. I keep messing you guys up. There we go. You're doing it for a debit, so it doesn't really work out as well that when you're doing that. But the further in the money you can go, the easier it is to get the credit. Now, when you have really high implied volatility, say for instance something that has like you know, super high implied volatility, then you can start moving this out of the money slightly and still get a credit. But you have to have really high implied volatility for that to usually happen. Put butterfly, broken wing butterfly, limits your risk to the upside. Okay. I'm sorry, John. John, I didn't mean to. I was still stuck on the rolling the trade out. You can do it out there. I don't like to do that out there that far, but because you're not getting that theta decay. But I was trying to make an example of rolling it out in time, and you're going to try and do it, roll it out in time and collect a credit. If you roll it out in time and you can't really collect a credit and you're paying a debit, I wouldn't roll it. I would just let it ride. Does that make sense? 69, with that out there in the, so let's look at even another example. I'll pick one that has something with earnings in it, try and get something with high implied volatility like Activision. And we'll do another example here. So for instance, this one's trading around 63, 62 and a half. So we could look to sell two of these 62 and a halves, buy the 60s, and then look at this here. We got $1.64 to spend, so that's basically the skip strike there, and buying those. We get a 39-cent credit. Okay, we could look at it doing the 65s, which is slightly out of the money, and hope I haven't vetted these strikes, so I'm not sure if it's going to work. $1.99, buy those, sell two of those, and then 84-cent credit. We skip the strike, so I got the 2.5, so the 7.5s would be the strike, and buy the 70s. We still get a 2-cent credit. Okay, so that's why when you have higher implied volatility, you can get a little further. You can do the out of the money ones, selling the out of the money. When you're really low implied volatility, you will not be able to do that. 75s. Well, you could do the 75s also, but at the end of the day, that is still a skip strike because it's 67 and a halves is the strike I'm skipping here to go to the 70s. Right? Oh, you want to look at you want me to look at are you John or Robert? I'm not sure. So you want to look at the 60s, buying the 67 and a halves, that far out. We can try looking at that. Buying the 67 and a halves, selling 2 of the 70s, and then skipping the 2 and a halves and buying the 75s. It's going to end up being a debit by 3 cents. This could be one of those, if you were a little bit more bullish on it, just put it in for 0. I wouldn't pay a debit for it though. I refuse to pay a debit for this, because otherwise you might as well, if you're going to be paying a debit, you might as well just do the regular butterfly. Okay. The theta is relatively small compared to the delta, so it's not really a neutral trade. You're correct in that. I didn't want to get into that with everybody. It's not really necessarily a neutral trade, because you have that downside. That's because of the downside there. It's basically neutral to bearish in a sense. You don't want this thing to move up fast at all. You'd rather have it kind of stay right there for sure, or go down. You would like it to have that downside move rather quickly, actually, and then with the expectation that it's going to come back up to that point. Does that make sense? Does that make sense to everybody there? Okay. So wait a second here. Does anybody else have any other real quick questions for me about this? Oops. Sorry about that. You know what, Jans, I'll go over that in just a second here. You guys, this is the offer right now. This is going to, I don't know how many more days we're going to be doing this one, but it's a really good one. And I'm putting that link in the chat window right now. Basically, I talk about this, I beat this to death, I know, but it is super important to think about trading strategies with higher probabilities, or increase those probabilities of success. Just like with this particular broken wing butterfly, we're increasing our probabilities of success by eliminating all of the downside risk in here, okay? By collecting that credit. So, you guys basically need to be trading with this type of knowledge, where you're trading with probabilities rather than thinking about it as money. What's one of the first things I learned on the floor? A guy told me, that's when you make it over that hump of being a real trader, is you stop thinking about trades as money. It's too emotional. You get emotional attachment to money, and when you're thinking about it as probabilities, it kind of puts everything into more perspective. And this is a great deal. There's hours and hours of strategies with this particular option trading webinar offer, and it's for $36. You guys should really take advantage of this. And the best way to become a better trader, you guys, is to learn, and you guys are obviously doing that by attending this webinar. But wouldn't you say creating just a broken wing butterfly and not really knowing how to set it up to increase your probabilities of success is not enough to create consistent winners in a sense? I mean, I know you can go out online and learn how to do a broken wing butterfly. They're gonna say how to do it. You're gonna skip that strike and put that embedded call spread in there. Possibly they might tell you that, but they're not going to tell you to not do it as a debit spread, because that's just ridiculous to increase your risk to one side and still have risk to the downside. So it's really important to know how to set these things up correctly and increase your probabilities of success. So, and I teach it just like that, how to play the probabilities, when the probabilities have gone against us, how we stay mechanical and increase our probabilities even further in our favor. I mean, that's the best way to create alpha in your portfolios, is increasing the probabilities and trading options for that matter. And when you're using the right tools in the right situation, guys, you're going to be more productive. State of mind. Oh, the link is not in there because okay, yeah, the link should be in there. Is everybody I'm seeing somebody say that in the chat window, it might not be in there. I'll throw it in there again. That you increase your probabilities of success, you're going to be a better trader. And using the right tools, like I said, right strategies increases your opportunities and ultimately will increase your probabilities and build confidence. All right. So we got this trial for you guys today. I suggest you sign up for it. And for this price, it could pay for itself right away for sure. And if you learned anything at all from me today, you guys should be taking advantage of this. So what do you say? Go ahead and click on that link and we'll get you set up straight away on this offer. And if you have any questions, you can call us at 310-598-6677 or you can email us at trading@protraderstrategies.com. Later webinars, you guys, I'm going to be drilling down on other option components, when and where trades I find appropriate. And here's also the link. This is a dead link, though. The one that's live is in the chat window. We've been communicating back and forth with questions, but the live link is in the chat window. But if you're watching this on replay, you can pause it and punch that into your URL. And like I said, you can reach out to us at trading@protraderstrategies.com or 310-598-6677. All right. So I'll throw this link up there. Whoops, that's the wrong one. Throw that link in there. So I'll try and hit some of those questions. I saw people were blowing me up. Paris said she had no questions, and then all of a sudden, Paris, believe it or not, everybody was blowing me up right below you. All right. So could you please tell us how unbalanced butterflies differ from 1, 2, 3 strategy? Profit graphs are very similar. Are you talking about when you say 1, 2, 3 strategy? I don't know what that is. Is that just a regular butterfly strategy, Jans? Thank you. I have this training. Very good for understanding. Thank you, Jans. Appreciate that. He meant an unbalanced broken wing butterfly. There are about 8 hours of different earnings options strategies. Sorry, I didn't explain that further. And we're getting right into earnings season. So basically, this is earnings with options. So it's going to be based around earnings season. So if you want to take advantage of trading in earnings, this is a great course for that. I basically cover all my favorite trades that you will see me trading in the daily market commentaries. I'm going to be talking about these same option strategies and when I'm putting them on, following those rules for the earnings. Earnings are too unpredictable. Could go up or down on earnings date. Yeah, absolutely. But you know, Robert, I agree with you. They are very unpredictable. I agree with you in the fact that they are very unpredictable. But you know, I'm setting it up with high probability. I'm playing the probabilities, right? Probabilities beat me on Costco today. So, you know, I've got that going for me because now I know the probabilities are in my favor going forward. The way I look at it, okay? You're welcome, Paris. Thank you for your kind words. If you have a minute, can you clarify what is the MMM price? That's the market maker move shown at the top of the MMM is market maker move, and that's based on volatility. So let's look at it. If you're talking about this market maker move right here, that's what the expected move is basically overnight for the next day. And basically what it is you take the straddle, and this is also part of the earnings. I talk about all this stuff in the earnings one, but basically it's 80% of the straddle is very close to what that is. But that's all covered in the in this course here. I go over all that stuff, excuse me, in detail. I enjoy these sessions. Thanks, Eric. Have a great weekend. Thank you, Edward. I appreciate it. Thank you, Mauricio. Okay. Yeah, Jan's, if you could just throw your question in again, I'll go to it because I'm trying to go through all these real quick. Are they defined risk, defined gain strategies? If you're talking about the earnings trades, I do have defined risk ones like iron condors and the call spreads, IRA appropriate stuff in there too, yeah. And then I also go over the undefined ones. So, you know, I look at it like the undefined ones actually have less risk than defined, and I could go over that all. Sorry. You're welcome, Jans. Yeah, I got everybody pretty much. Have a good weekend, Charlie. Appreciate it. Do you mean the undefined risk? Well, undefined risk, yes. Undefined risk strategies, I believe, have undefined risk strategies have higher probabilities of success. So in a sense, if you have a higher probability, if your probability of success is 85% and your probability of success is, 65%, which one has more risk? One with only a 65% probability of success has more risk, right? Well, usually when you're doing defined risk strategies, you're using a delta that's closer to the market, which is increasing your risk in a sense. Is the course online? How long will we have access to it? You basically have access to this course until you're done with it. And then, I mean, you can go back and watch them again and stuff like that too. So it's actually really nice. You go in there and you check off the ones that you've seen. Whoops. You check off the ones that you've seen. That's the wrong one. Sorry. Check off the ones you've seen, and you can rewatch them and stuff like that. Oh, Jans, you're talking about a 1x3x2. So that's actually we used to call that a Christmas tree. 1x3x2 is a Christmas tree, and I actually have done a full-on webinar on that. So you can check that out at Pro Trader Strategies, but look for a Christmas tree. Okay, yeah, definitely. How many hours is the material? If I'm thinking correctly, it's probably 1, 2, 3, 4, 5, 6, 7, 8, like 8 or 9 hours of video. Sorry, you guys are scrolling off really fast. So trader hack on the market maker move is the straddle or the strangle? The straddle. All right. Where's the webinar on the 1x3x2? It is the webinar on there is I don't remember which course it's under, but if you guys reach out to us at 310-598-6677, tell them you want the Christmas tree, they can set you up with that. Okay, guys? Great. All right, make sure you guys click on that link and check that out, because we're going into our earnings season, and earnings are a lot of fun. I know that they're pretty volatile, but when you have volatility, you got to take advantage of it. All right. You guys all have a great weekend, and if you can't take that, take it easy. Bark at the moon, baby. Love it, Charlie. Appreciate it. Take care, everybody.